Well, welcome everyone to the CFO Controller webinar series that Richey is putting on. Again, welcome. For those of you that have been on the first couple of webinars, you're aware, but for those that this may be the first one, I just want to kind of let you know what we're trying to do with these. So we're working on a series of webinars to highlight current and emerging topics that will have a direct effect on your operations and decisions. And we will cover a large range of topics such as journal audit and accounting, tax compliance, tax planning, mortgage banking specific topics both on the accounting and tax side. And of course, best of all, these webinars are presented at no cost to the participants and are designed for the benefit of our clients. So again, this is the third one. If you missed one of the first two, the first one is uploaded to our website. You can go look at it there. The second one, I guess we had a few technical difficulties, so we're working on trying to get that one uploaded as well. And this one is also being recorded and will be posted to the website hopefully shortly after we complete the webinar today. So before I jump into today's topics, if this is your first time, there is a section to enter questions. I am working solo today, so if you have questions, I will try and monitor those and respond to them as best I can. If I don't get to your questions, I'm hoping that I can, retrieve them from the webinar somehow, and I'll either respond to them via email or phone call and try and get all of your questions answered. All right, so today's topics are tax-oriented. We're going to talk about issues with, or I should say possible issues with net commission formulas for payroll tax. And then I'm going to talk about some of the 2011 and 2012 key tax highlights. And then we'll wrap up with some common book tax adjustments for mortgage banks. My name is Jared Frost. I'm a senior tax manager with Richey. Have been with the firm for about 2.5 years now. Prior to joining Richey, I was with KPMG for over 7 years and worked for them in Los Angeles and Phoenix, Arizona. That's a little background on me. Also, just want to make a mention that the next installment of our series is scheduled to occur sometime near the beginning of May, and we're still trying to develop topics to discuss on that webinar. So if anybody has anything that they're interested in us presenting on, feel free to shoot any of the managers, partners, account managers that you deal with an email and let them know which topics you're interested in hearing about. Finally, I got to put in the typical tax disclaimers. The first is that these materials are prepared solely for educational purposes. And in Circular 230, we're required to let you know that any tax advice contained in the body of this material is not intended or written to be used and cannot be used by the recipient for the purpose of avoiding penalties that may be imposed under the Internal Revenue Code or applicable state or local tax provisions, or promoting, marketing, or recommending to another party that any transaction or matter addressed herein. And then finally, that last one just deals with the fact that these rules are constantly changing. There's always new legislation and cases, regulations that come out, and we closely monitor those changes. So before implementing any of the planning ideas contained in these materials, we suggest that you contact us, and we just want to make sure that we get everything right for you if we're going to apply it to your specific situation. And with that, we'll dive into our first topic, which is potential issues dealing with the net commission formulas for payroll tax. So loan officer compensation, obviously it varies dramatically from company to company as far as how you guys are compensating your loan officers. Usually the compensation is done with some type of commission formula, and loan officers are typically reimbursed for ordinary and necessary business expenses. And then certain of those expenses or other expenses incurred by the company are usually netted against a gross commission, and you arrive at some type of net commission. And then when you report that commission for payroll tax purposes, you're usually reporting that net commission on the W-2 and doing proper, withholding and payroll tax on that net commission. So like I said, the net commission is treated as a gross compensation, and what this does, and what the concern of the IRS is that this is going to result in a lower payroll tax obligation, because rather than reporting the gross commission before expenses being netted out, we're reporting the net commission. And then another kind of side topic is the fact that it results in a lower loan officer income tax liability, because the full expense was netted against his commission, versus if the gross commission was reported on his or her tax return and the expenses were reported on his or her tax return. Those expenses would likely be subject to a 2% floor for unreimbursed business expenses, and those are itemized deductions, which would be subject to phase out if you're a higher income taxpayer. And also the meals and entertainment type expenses would typically be subject to a 50% limitation on their personal return. Instead, if they're being reimbursed for those, it's not subject to that limitation. So the question becomes, if I am examined by the IRS, would companies using net commission formula be subject to additional withholding, employment tax, penalties, interest, those types of assessments? And because the IRS would obviously rather that you report the gross commission as opposed to the net commission. And unfortunately, we don't have a clear, cut and dry answer to this question, but we do have what I did want to do in this presentation is kind of outline the taxpayer guidance that is out there and just kind of make you aware of the issue, and then also possibly make some recommendations as well that would not necessarily guarantee that the net commission formula works, but would hopefully put you in a better position should you be audited on your employment taxes. So with that said, I'll talk a little bit about the taxpayer guidance that is out there right now. First, what's really sparking this is the accountable expense reimbursement plan rules that are contained in the regulations 1.62-2. And in those regulations, they talk about how in order for expense reimbursements to employees to not be included in gross wages of the employees, the expense reimbursement plan must have three things. And the three things that it must have is business connection, substantiation, and then it must also call for the employee to return any amounts that are in excess of the expenses which are actually incurred. So to have a business connection, the expense incurred by the employee must obviously be in connection with the business, and the expense must, if the expense were incurred by the company rather than the employee, it must be deductible under current tax law. So that's the business connection requirement. The next requirement is substantiation. And this is, documentation must be provided to the employer that supports the expense incurred by the employee. And then finally, the amounts in excess of the expenses actually incurred must be returned. So I think most of you guys probably have already adopted an accountable expense reimbursement plan and are hopefully fairly familiar with these rules. If you have any questions about your plan, feel free to reach out to your account manager or manager partner here at Richey May. We'd be more than happy to help you make sure that those plans are in alignment with these rules. One exception to the returning amounts in excess of expenses, actually two exceptions, are for per diems. If you use a standard federal per diem rate for meals and entertainment types expenses and or lodging expenses, then any excess that, if the per diem rate was $22, for example, and the employee only spent $16, then he doesn't have to return the additional $6. The other one is in mileage rates. The IRS has established standard mileage rates, and those rates are supposed to reimburse the employee for gas and insurance and maintenance of the vehicle. And obviously if that mileage rate is higher than the actual expenses that are incurred by the employee, then no, they don't have to return those amounts either. But those are the only two exceptions that I'm aware of. So that's the accountable expense reimbursement plan rules. The preamble to these regulations and example 1 of these regulations hit on one of the potential issues with the net commission formula. And what the example demonstrates is it basically says there's an employee that earns $200 a day, and that's the employee's salary. But on days where the employee travels, the employer essentially recharacterizes $50 of that $200 salary as expense reimbursement. And what the example says is this is not an accountable expense reimbursement plan because the employee was going to earn $200 whether he or she traveled out of town or not. So the fact that you want to recharacterize $50 of that $200 as expense reimbursement does not qualify it as expense reimbursement, and as such the full $200 is subject to federal withholding and other payroll taxes, as opposed to the $150 net of the expense. The other guidance that's out there that also touches on this is there was a private letter ruling issued back in 1993, and essentially the crux of this private letter ruling was the taxpayer was asking the IRS if a certain structure, kind of involving a certain commission structure, would qualify as an accountable expense reimbursement plan. And what happened in this ruling is the company was paying district managers a gross commission, and the district managers were then responsible for all the business expenses, i.e. there weren't any reimbursements from the company. So they got a gross commission of $100, and then they were responsible for all the expenses that they had to incur in performing their duties. So if they incurred $25 of expenses, they had $100 gross commission and $25 of expenses. But since the company wasn't reimbursing, they would have to report all of that on their individual 1040 tax return, personal tax return. And the company asked the IRS if instead of paying this gross commission, if we allowed the district managers at the beginning of any year to elect to reduce their gross commission by 40%, and then we reimbursed the expenses that would qualify as expenses under an accountable expense reimbursement plan, would that allow us to only withhold on the now 60% net commission and then reimburse for expenses? And the IRS said, no, that doesn't work, because they called the 40% reduction an assignment of income. So they said, no, what the employee is really earning is the full 100%, and they're assigning 40% of that income back to the employer, and that doesn't qualify as under an accountable expense reimbursement plan. So they said that under that scenario, you would have to do withholding on the full 100% gross commission, not the 60% net commission. So you can understand, based on both the example, the preamble and the example contained in the IRS regs on my previous slide and in this private letter ruling, why this is concerning to us for our mortgage banking clients, because, as I said on an earlier slide, often these commission formulas for loan officers are netting out these types of expenses, and that net commission is typically what's reported on W-2 and what withholding and payroll taxes are computed on and paid to the IRS. So really, in our minds, the issue comes down, there's really two issues at play here. One is the recharacterization of income, and the other is the discretion to incur expenses lies with the employee and not the employer. And that's really kind of what we gleaned from these examples, that the IRS does not want taxpayers recharacterizing income in order to avoid the payroll tax. Like I said in the previous example, taking 100%, instead of paying on 100%, they were only going to pay the payroll tax on the net 60%. Excuse me. And so they're recharacterizing 40% of that income in order to accomplish that. And then the other thing is that the discretion for paying expenses really rested entirely with the employee, and the employer had no say in what types of expenses were incurred by the employee. So when we get to our recommendations, I think it'll become a little bit clearer. This will hopefully clear that up and help us understand what we can do to try and avoid these two issues that are being brought up by the IRS. So obviously the conclusion is that the IRS wants payroll taxes paid on gross commissions before netting out any expenses. And so the question then becomes, what can we do? What can our mortgage companies do with these loan officer commission formulas that net expenses against a gross commission? So here are our recommendations. We kind of have the more conservative approach and then what I call the less conservative approach. The more conservative approach is to go to kind of a more traditional commission formula, which would separate the gross commission from expense reimbursement, i.e. you wouldn't have any netting of expenses in the commission formula. So it would just be, loan officer gets a straight percentage commission or basis point commission or whatever. There's no netting of expenses incurred by the loan officer. Then there's an accountable expense reimbursement plan, and the compensation agreement would basically say that there are certain expenses which the company will reimburse. So that's obviously very conservative, because in that case you have completely separated the commission formula from the expense reimbursement, and so that shouldn't present any issues under these rules. But that also provides some competitive disadvantages in the marketplace, because this is not the typical structure for loan officers of a mortgage company. The less conservative approach, and the more, the one that has a little bit more risk associated with it, is, but when I say that, I mean it's, there's definitely some risk, because we're netting these expenses in, and we're only withholding and paying payroll tax based on the net commission. But we have a couple of suggestions here that we think will at least help you defend the position, but obviously we can't guarantee it. There's just not enough guidance and literature out there, and we haven't had, at least to our knowledge, we haven't had any of our clients be audited have an employment tax audit where this issue has come up. So we just don't have enough data points to really know what the IRS would think of some of these net commission models. But what we suggest you do is, in your compensation agreements, refer to the gross commission as the commission less certain expenses. So, a lot of the times the agreements will say you get a gross commission of 50 basis points or 100 basis points or whatever kind of that gross commission formula is, and then from there we're going to back out these certain expenses, and that's going to get you to a net commission, which is your pay. What we suggest doing, it may seem like semantics, but what we suggest you do is, rather than call that gross commission the 50 basis points or 100 basis points or whatever, refer to the gross commission as 100 basis points less these prescribed expenses. And the more detail you can provide in saying these are the expenses that are going to be netted out, we think that puts you in a little bit better position, because now you're saying that the loan officer was never really entitled to this gross commission of 100 basis points. They were only ever entitled to this 100 basis points less these prescribed expenses. And so we think that that'll help a little bit if you come across a situation where you have to argue this before the IRS. Continue to have an accountable expense reimbursement plan. I'm imagining that most of your companies do. Again, if you're not sure about how well your accountable expense reimbursement plan is, how good it is, feel free to reach out to us, and we're more than happy to help you try and establish the best plan. And then finally, as much as possible, try and remove the discretion for incurring expenses from the loan officer to the company. So if there's a pre-approval process or something of that effect that basically allows or forces the loan officer to get pre-approval of some kind for expenses that they incur, we think that'll help as well, because then you can show, well, these really aren't loan officer expenses, these are expenses of the company, and so therefore that's why we're reimbursing them for these expenses, but it can also be incorporated into that net commission formula, which you're going to call a gross commission formula. So, some of this may seem like I said, may seem like semantics, but we're just trying to find ways to inform our clients that there is an issue here with this these net commission formulas where they're netting out expenses, and we just want you to be aware of it, and maybe if you take a few of these steps, it'll help you in a defense in front of the IRS. Again, we want to make it abundantly clear that we haven't seen anybody audited on this issue. We haven't seen this become a widespread problem within the mortgage banking industry. But if you got a couple of savvy IRS agents that pick up on it and start digging in, it could become an issue. So we just wanted to bring that up. That is it on net commission formulas. Again, if there's any questions on anything I've gone over, feel free to try and throw those up in the question area. I'll do my best, as I said, to answer them. Working solo today. If there's anything specific to your company, your organization, feel free to reach out to your account manager or the manager or a partner here at Richey May, and we can certainly assist you through that process. All right, let me move on. So now I want to dive into some of the 2011-2012 key tax highlights. So some non-legislative developments. Cell phones are no longer listed property. For those that don't know what listed property means, that there are just certain assets that are, there's a potential for personal use of those assets, and so they became what we refer to as listed property in the tax world. Passenger automobiles, cell phones, those types of items. And they decided that cell phones, as long as they're provided to employees primarily for non-compensatory business reasons, if you're just providing to your employees so that you can reach them at any time, and they're going to use those cell phones primarily for business, then they're no longer listed properties. So you don't have to meet the requirement that the cell phone have more than 50% business use in order for you to take depreciation or be able to take expenses associated with those cell phones. So that's a nice little lightening of that requirement. The next one here is the spousal rights under 401k plans. Generally, under 401k plans, the spouse of an employee is considered to be the beneficiary should the employee die, and if the employee wants to designate someone other than the spouse as a beneficiary of the 401k plan, then there's a waiver that has to be in place, signed by the spouse, that basically says, yeah, I understand that there are other beneficiaries of this 401k plan, and I waive my right to be a beneficiary of the plan. If that waiver is not on file, then what it's basically saying is that legally that 401k plan is going to pass to the spouse, even though other beneficiaries are designated. So just pointing that one out. Just a quick question about, yes, we will be providing copies of the PowerPoint slides to everyone, so you will be able to get copies of these. Back to my last point here, self-employed individuals. Medicare premiums for self-employed individuals, they can take that as a deduction on their personal tax returns. And so if historically they haven't been taking a deduction for those premiums, they may have the ability to amend returns to go back and claim those. Oh, let's see. Sorry. Oh, going the wrong way. All right. The Hire Act. On the 2011 tax returns of the company, there is a $1,000 tax credit available for certain retained workers in 2011. And this, you may have heard about this. Back in 2010, I think it was we're actually going to get to it on the next slide. Maybe I'll just go there. Probably should have done this in reverse order, but back in 2010, there was a payroll tax exemption for hiring qualified individuals. And a qualified individual employee, as you look there at the bottom of the screen, was someone that was hired after February 3rd, 2010 and before January 1st, 2011. And the employee had to certify on a Form W-11 that they had not been employed for more than 40 hours during the 60-day period ending on the date of hire. So if the 60-day period prior to them being hired, they worked less than 40 hours, they could sign this affidavit on Form W-11. And the employee was not hired to replace another employee unless the other employee, separated voluntarily or for cause, or was laid off due to downsizing. And the employee cannot be related to the employer. So if the employee met those criteria, then the 6.2% wages that the employer has to pay, they didn't have to pay that for these specific employees during the period March 19th through December 31st, 2010. So if they were at the max wage base, that saved about $6,600 of employment tax. And then on top of that, and I guess the last point I want to make on this slide is If for some reason you had an employee that qualified and you failed to take advantage of this payroll tax exemption, you do have the ability to amend payroll tax returns for up to 24 months. So there may be an opportunity to go back and amend the return and get some of those employer-paid FICA taxes back. Now if I go back to this slide, this talks about the retention credit. So if you had one of those employees that qualified under what we were just discussing for the payroll tax exemption, then on the company's business tax return, whether it's for an S corporation, partnership, whatever, there's a $1,000 credit available if the worker was retained for certain periods of time. So it's the credit's the lesser of $1,000 or 6.2% of the wages paid to the retained worker. So if the worker made at least $16,000, then you're going to get the $1,000 credit. And the worker had to be retained for 52 weeks, and the wages for the last 26 weeks must equal or exceed 80% of the employee's wages for the first 26 weeks. And then it's the same qualifications. Had to be hired during that period, had to not be working for a 60-day period prior to the hire, and the employee not hired to replace another employee can't be related to the employer. So that's a credit that's going to become showing up on the 2011 returns that we are currently in the midst of preparing. So we will be reaching out to you, and one of the questions we'll be asking about is if you had any employees that you were able to take advantage of that payroll tax exemption, and if you were, then we might be able to get you a $1,000 credit. Okay, we talked about that. Bonus depreciation. This one's been around for a little while. It's on qualified new business property. It has to be purchased new, and it had to have a tax life of 20 years or less. So purchased used property is not qualified for bonus depreciation. From September 8th of 2010 through December 31st of 2011, the bonus depreciation was 100%, so you could effectively write off the entire purchase. For 2012, that drops back down to 50%, and it was 50%. Prior to 9/8/2010, it was 50%, and it goes back down to 50% in 2012. And it expires for all property acquired after 2012. So bonus depreciation is currently scheduled to phase out and disappear starting in 2013. However, with the election and who knows what's going to happen. The bonus depreciation rules for passenger autos, trucks, and SUVs. Like I said before, passenger autos are generally considered listed property. And also there are some special rules that limit the amount of depreciation that can be taken on passenger autos. So the maximum first-year depreciation for 2011 was generally $3,060, $3,260 for trucks and vans not weighing more than 6,000 pounds. The first-year cap increased to allow an additional $8,000 for bonus depreciation to make the total maximum for 2011 $11,060. And vehicles weighing over 6,000 pounds are not subject to these rules, so there's no first-year limitation on those vehicles. Now we come to the Section 179 expensing election. There was some favorable treatment here over the last couple years. For 2011, you could elect to expense $500,000 of applicable property that was purchased. So similar to the bonus depreciation rules. That number drops down to $139,000 for 2012 and is currently indexed that starting in 2013 that number will only be $25,000, which was what it was for years and years and years before some of these favorable treatments came into place, some of the Bush tax cuts. Phase-outs begin when asset purchases exceed $2 million in 2011. So if you have qualifying asset purchases of over $2 million, then the amount that you can expense drops dollar for dollar. So once you hit $2.5 million, the expensing election effectively disappears. For 2012, that number drops down to $560,000. So once you hit 560, it'll drop dollar for dollar, and currently it's indexed to be $200,000 starting in 2013. So, I'm sure the question is, well, if we have bonus for 2011 and we have 179 for 2011, which one is more beneficial? Well, generally, bonus is probably the way to go, although here I list out a few situations where 179 may be more beneficial. There is a provision that for certain qualified real property, which probably the one that'll apply mostly for this crowd is the qualified leasehold improvement property rules, which I'll go over here in a second. But if you have qualified real property, then you could actually treat $250,000 of the $500,000 that you could elect to expense. You could have that applied to qualified real property. Generally, this expensing election does not apply to real property, so that was an added benefit. And that is qualified leasehold improvement property, as I said, qualified retail improvement property, and qualified restaurant property. The last two probably do not apply. The qualified leasehold improvement property, I can tell you what that means. It's essentially improvements to a leased space to the interior portion, so not the exterior portion, the interior portion. And the improvement had to be made under or pursuant to a lease. The lease could not be between related parties. The building had to be occupied exclusively by the lessee, or the portion of the building. If you're renting a portion of a building, then just the portion had to be occupied exclusively by the lessee. The improvement is Section 1250 property, which 1250 property generally deals with real estate, so it's structural components mostly. And then the improvement is placed into service more than 3 years after the date the building was first placed into service. So the building that you're occupying and trying to take this qualified leasehold improvement, trying to qualify as qualified leasehold improvement property, the building essentially had to be 3 years old before you made the improvement to the property. So if you meet those criteria, then traditionally you had to, this qualified leasehold improvement property, traditionally it was depreciated over 39 years, which is the same life as the original real property was depreciated over. If it's qualified leasehold improvement property, that dropped from 39 years down to 15 years. And also they put this special election in that allowed you to write off up to $250,000 under Section 179. Other situations where it may be beneficial to take 179 instead of bonus is if the property is not eligible for bonus because it's, for example, used property, or if it's qualified restaurant property, qualified retail property, then those were not eligible for bonus, so 179 would be the way to go. There's also state tax implications because certain states limit the ability of taxpayers to utilize bonus or Section 179. Sometimes they don't allow it in its entirety. Sometimes they allow portions of it. So there's really varying stances from the states as to whether or not bonus or 179 will apply. Selected key tax breaks expiring after 2011. The qualified leasehold improvement property is scheduled to go away, so it'll go back to 39 years as I had discussed before. The R&D credit has expired as of 12/31/2011, although historically we've seen this thing expired and then get reinstated and reinstated retroactively, so it very well could come back again. And then there's some favorable S-Corp charitable gain provisions. basically if an S corporation made a charitable contribution of an appreciated piece of property, so if the S corporation owned a piece of land and donated that piece of land to a charity, and their basis in the property was, let's say, $25,000, and the fair market value of the property was $100,000, they can take a charitable contribution for $100,000, the appreciated value of the property. But historically, that the basis of the S corporation stock to the shareholders was only reduced by the basis of the property, or the $25,000, and those rules have now phased out. So now, if a charitable contribution is made of appreciated property, the basis of the stock of the S corporation is going to be reduced by, in my example, by the full $100,000, not only the $25,000 basis. They repealed the expanded 1099 reporting requirements. They had originally put some provisions in that were going to require 1099 reporting to all corporations, and also reporting it for the purchase of property. Generally, the 1099 reporting requirements only apply to services, and they were trying to put a rule in that would apply it to the purchase of property. Fortunately, those rules were repealed, and so we're back to the original rules. And so generally, 1099 reporting is not required if payments are made to a corporation, and they're not required, with a few exceptions, and they're not required for payments made to purchase property. Here's just an announcement that was just warning employers about using outside payroll firms. So if you use a payroll service provider like an ADP, or I'm trying to think of the name of the other one, but anyways, if you're using a payroll service provider, or if you're using a professional employer organization, which is if you set up like kind of a separate company, and that company holds all your employees, and they're responsible for handling all the payroll taxes of your employees. If those obligations aren't met by either the PSP or the PEO, that the ultimate employer is still responsible for those taxes. So just kind of a warning there. Finally, this talks about the medical benefits that are extended to children aged 27 and up. Basically, a child under the age of 27 can be covered under their parents' medical plan until they reach the age of 27, and so there's just some rules there. Deductions for self-employed. This is kind of a misnomer. It's not necessarily only self-employed, but you have your typical automobile expenses. You could use the standard mileage rates, and I've listed them here, 55.5 cents. And just a note that 22 cents per mile of that rate is considered to be depreciation. So if you have to do a calculation to determine a portion of a vehicle that is business use versus personal use, the basis of that would be reduced by this 22 cents per mile. And then there's also the actual expense method. I mean, you could, if the business use percentage is more than 50%, you can use depreciation and operating expenses rather than just the standard mileage rates. But if the business use drops below 50% after that, then you have to recapture any depreciation that was taken in prior years. And just a note that commuting miles are not business use miles. And then I talked about the subsequent decrease. Meals and entertainment, these are just the standard rules. You're required to be either directly related or associated with business. So it needs to be, business discussions. Associated with required that the meal or expense precedes or follows a substantial and bona fide business discussion. And then substantiation, you have to be able to establish the amount spent, time and place, business purpose, business relationship of the individuals involved, and receipts are required for expenditures of $75 or more. Companies generally have a lower standard than that, but that's the IRS standard. Meals and entertainment, again, some exceptions where the 50% limitation does not apply would be like a recreational company-wide or office-wide event, such as a picnic or a holiday party, or if it's a de minimis working condition fringe, which are if it's an occasional and practical to account for type thing. An example, if you order a pizza for everyone working overtime on a special project or something like that, then those types of meals are not subject to the 50% limitation. They would be 100% deductible. Deductions for the self-employed. Again, we got the home office deduction. There's some tests here. I don't want to go too much into detail on this because we're running out of time. I got a couple other things I want to cover, but there are opportunities for people that use a home office as kind of a principal place of business or exclusively for business. There's maybe some opportunities to take a deduction related to the portion of the home that's used as a home office. Website development costs. Kind of have to break these down into three categories. You got design costs. Design cost purchases are amortized over 3 years. And then you have your kind of non-customized software portion. So if you're just kind of your off-the-shelf stuff, no real design associated with it, those are eligible for bonus and 179 and would also be depreciable over 3 years if you don't take advantage of the bonus or 179. And then the last portion would be advertising, and to the extent you could say that the development of the website is attributable to advertising, those would be immediately deductible as advertising costs. And then this is a more obscure rule. They've put a credit in place for small businesses that establish a pension plan. Basically, you can take 50% of the startup costs and the costs incurred to administer the plan for the first 3 years. You can take that as a credit. The maximum credit is $500 per year. So if those startup costs or plan administration costs exceed $1,000, you're going to be capped at $500. Must have no more than 100 employees who earn more than $5,000 in the prior year. So basically, if you have more than 100 employees, this credit's unavailable to you, and must have at least one non-highly compensated participant, and must not have terminated a retirement plan in the preceding 3 years. Okay, last couple of things. I know we've only got about 10 minutes or so left, so I'm going to try and go through these fairly quickly. I just want to talk about a couple of common book tax adjustments. One's related to interest rate lock commitments and then the associated hedge, and then another one's related to the loan loss reserve. So derivatives, this kind of just talks about how we get to the book tax difference. GAAP, they record a derivative at fair value, so they create an asset, record revenue. For tax purposes, our position at Richey May and our understanding that the industry position is that there's no asset created, and therefore we should be able to reverse out this revenue that gets booked for GAAP purposes. Similar thing on the hedging side. Again, the hedge gets recorded at fair value. It creates an asset or a liability. So you record revenue or expense, depending on which way it's going. Again, for tax, no asset liability created. Again, our position and our understanding that the industry's position is that there's no asset or liability created. You reverse the revenue expense. If there's a portion of the hedge that's related to closed loans held for sale, that portion is not reversed because closed loans held for sale are required to be reported using the mark-to-market rules, which are very similar to the fair value concept for GAAP purposes. So there may have to be a slight bifurcation of the hedge to the extent the hedge is covering both closed loans that are uncommitted to an investor, for example, as well as interest rate lock commitments. So the issue is on these interest rate lock commitments and hedging, we've kind of gotten an inconsistent position from the IRS as to how these should be treated for tax purposes. Again, Richey may feels, as we've read through the rules and all the guidance that's out there, and as we've associated with people in the mortgage banking industry, we've drawn the conclusion that the industry as a whole takes the position that these assets do not need to be created, that no revenue needs to be booked related to your interest rate lock commitments or your hedges. However, we attempted to file a method change request for a client that had previously picked up this revenue in taxable income and paid tax on it. We were trying to file a method change request with the IRS to allow us to reverse that treatment and to allow them to reverse out the revenue for tax purposes. And when we put the request in, we got a call from the IRS, and they said that their position is that these derivatives are securities for tax purposes under 475, and that the mark-to-market rules apply, and therefore they should have to pick up the revenue. And we're still trying to work through that to figure out what other options we have to try and get these method change requests in and see if we can get them through this group. The thing that causes pause is that we've had a few clients examined by the IRS on this issue, and it's kind of been mixed results. We had one where they kind of settled on a position where they agreed that it might be a security, but the value of the security was some very small number, because if you think about, I've got an interest rate lock commitment, and if I have a corresponding hedge that I'm using to basically try to lock in a price, if I'm correlating that hedge properly, then my interest rate lock commitment, my hedge should, effectively offset, maybe, not perfectly obviously, but the value of the two netted together should be a very small number. And so the IRS agreed under that examination that was okay, and so it ended up in a very small value being associated with it and very small revenue being picked up. We've had other examinations where they just, they agreed, I don't know if they agreed with our position, but they allowed our position to be taken on the return. No revenue was picked up, and it went through audit that way. We have another client that's under audit that is being looked at right now, and we're kind of going back and forth with the IRS as to what the treatment should be. That first bullet point there really kind of hits the nail on the head. Is the IRS is, they seem to be, their position seems to hinge on when the mortgage company is committed to originate the loan. And so what we're trying to discuss with them is that, the day that an interest rate lock commitment is agreed to between the borrower and the mortgage company, nobody's under any obligation to really do anything. I mean, all we've done is effectively said, if we originate a loan down the line, 30 days from now or 45 days from now, whenever it is, if we originate a loan, then this will be the price. But no commitment has been made to lend at that point, because there hasn't been any underwriting, or there may not have even been an application taken. So it's just we're trying to tell the IRS, look, there's no commitment to lend at that point, and we're just trying to understand and talking with our clients, when exactly is the company committed to originate the loan? Is it right after underwriting? Is it not until close? And trying to see if we can work with our mortgage clients to understand when does that exactly happen, and then try and discuss that with the IRS and see if we can't make some headway on this position. All right, the last item I want to talk about is the loan loss indemnification reserves. The GAAP treatment obviously is that the reserve goes up for actual and estimated losses from repurchases or indemnifications. The decrease is actual losses, when paid. And generally, for tax purposes, we can only take a deduction for the actual losses when paid. So we generally reverse out kind of the change in the loan loss or indemnification reserve, and by reversing out that change, we're reversing out any estimated losses that are increasing that reserve, but we're taking a deduction for the actual losses that were paid during the year. So that's kind of the general treatment. Repurchases, there's kind of a split here. If you repurchase a loan and your intent is to resell the loan if possible, and if you've actually made attempts to try and resell the loan, then we can probably apply the mark-to-market rules under 475. And so if that loan has decreased in value, that could result in a deduction. If the intent is to hold the loan in your portfolio, then you would take cost basis, and so whatever you pay to repurchase that loan would go on your tax return, or in your tax records at cost basis, and that would be the basis that you would use if you ultimately are able to sell the loan, or if it becomes an REO property after foreclosure or something like that. Indemnifications, where you're not actually repurchasing a loan, those are just an ordinary trade or business expense under Section 162. So a little bit different treatment there. And there's an opportunity with these indemnifications with this last bullet point talking about the recurring item exception. I'm going to get to that in just a second. So the recurring item exception is in the regulations under 461-5, and there's really kind of three requirements that have to be met in order to apply the recurring item exception. One is the all events test, and what the all events test essentially says is that all events have occurred that establish the fact of a liability. So if you're working on some of these indemnification requests from investors, and you're kind of negotiating back and forth and nothing's really been decided and nothing's really been settled, then you haven't met the all events test. And in order to apply this exception, you have to have met that test by the end of the year. So for a calendar year taxpayer, that test has to be met by 12/31 in order to apply this exception. The other thing that has to be met by 12/31 is that you have to be able to reasonably estimate the amount of the liability. So if you've kind of come to an agreement, or you acknowledge that there is a liability that associated with an indemnification, and you can reasonably estimate the amount of that liability, then there's an opportunity to use the recurring item exception. And what the recurring item exception effectively allows you to do is, if you look at your indemnification reserves at the end of the year, and let's say there's $100,000 in that reserve, and the makeup of that $100,000 is, let's say it's $50,000 of estimated future losses and $50,000 of actual indemnification, requests. And you look at that $50,000 of indemnification requests, and you determine that, okay, yeah, we've essentially settled on a couple of these that amount to $20,000, let's say. And so you've negotiated with the investor. You kind of have agreed that you have a liability, and you've at least estimated, if not fully determined, that the amount of that liability is $20,000. Then what you can do on the recurring item exception is, as long as that $20,000 is paid before you file your tax return for that year, then you can actually deduct it on that year's tax return. So, for example, if you determine that $20,000 of your indemnification reserve at 12/31/2011 is related to indemnification requests that you've effectively settled with the investor, and you've determined that the amount's $20,000, as long as you pay that $20,000 before you file your tax return sometime in 2012, you can actually deduct that on your 2011 return versus having to wait until you deduct it on the 2012 return. So what we recommend to our clients is, at the end of, in that fourth quarter, when you're looking in November and December, and you're kind of looking at these indemnification requests or repurchase requests, really take a hard look and see if there's if you have the ability to try and settle some of these prior to year end, or at least get to a position where you acknowledge that you have a liability and that you're going to owe some amount in the future on this indemnification request. And as long as you've kind of reached that point and we can reasonably estimate what that liability is going to be, then as long as that gets paid before you file your tax return, we can bring it back and take it on the current year return. That is all that I have. I appreciate those that joined us today to talk about these tax issues. I hope it was beneficial and that you got something from it, in that you could understand me. If you have any further questions, like I said, on any of these topics, feel free to contact your account manager or manager partner here at the firm, whoever you deal with on the tax side here, and we'll be more than happy to try and help you through some of these things. Again, as shown here on the bottom of the slide, copies of these slides will be emailed to everybody that was on the call today, and so I'll make sure to get those out to you. And again, I'm Jared Frost, Senior Tax Manager here at Richey May. I think that's it. So I hope you have a wonderful rest of your day and rest of your week, and we'll be in touch with you soon. Take care.